and welcome to Fresh Perspectives. My name is Gail, and my guest today is somebody who's been on a couple of times before, so you probably will remember him. His name is Randy Cannon, and he is here today to talk about what was the...
We talk about title insurance.
Title insurance, okay. He's here to talk about title insurance. Now, Randy, did you have a good Thanksgiving?
I had a very good Thanksgiving. It was a very intimate Thanksgiving, but it was nice to be with family and be able to kind of take some time aside, so yes, and hope you had a good one as well.
Oh yeah, there was just 4 of us.
Nice and cozy.
And you said there was just 3 of you, right?
Yes, exactly right. Yep.
Okay, well, safety first, right?
That's right. Unusual times call for unusual measures.
If you're not careful, you might not be celebrating any more Thanksgivings in future years.
You're right, yep.
Okay, Randy, tell us what title insurance is.
Well, thank you very much. Thank you for having me on your show again.
Oh, you're welcome.
And you may remember that I think it's been about 6 months ago that we talked about the history of real estate in Chautauqua County.
Right.
Some of the folklore and some of the rich legends that we have around here. And then a couple months later, we talked about kind of abstracts of title, and I told you about what the purpose of an abstract is and what it does and what it's supposed to do for you when you're preparing to buy a home. Well, there's kind of a two-pronged nature to real estate. So today we're going to look a little bit at title insurance. Now, we think insurance and we think all sorts of things. We think of car insurance, homeowners insurance, health insurance. There's all kinds of insurances. And if you've ever watched TV, you know that you're bombarded with insurance ads about all the things that you can do.
Yeah, you know, it's really funny that if you bought all of the insurance that the insurance people want you to buy, you wouldn't have enough money for everything else you need, because they always talk you into increasing the amount you have.
Well, and the idea is that the amount of premiums that you pay will never really cover what you're going to be using it for in the first place, and that's kind of really the profitability of it.
Oh, is that why they do it?
Yeah, so with title insurance, it's a little bit different. Some people have heard about it, some people have not. But I'd like to kind of start with a little bit of the background of it.
Okay. And
then a definition and what it does and what it covers. And then kind of go on to tell maybe a couple of differences between the different types of title insurance. So, a title insurance is meant to basically cover your investment on your property. You know, real estate's one of those things that never really depreciates, it usually appreciates. And so you want to make sure that the investment that you have in your property is covered from possible claims, and we'll get into that a little bit. So where this all stemmed from, and title insurance, I was doing a little bit of looking up on one of the insurance companies' profiles, and the need for title insurance started in about 1868. And what happened was there was a gentleman, I believe it was down in Pennsylvania, who was buying a house, and when they were doing the research of the records, as we mentioned with the title search last time, they discovered that there was a lien on the property. And so the gentleman who was going to purchase the property was aware of it. His attorney was aware of it. And so he asked his attorney, do I need to be concerned about this? And there was some disagreement between the parties about how serious of a matter this was. But in the long run, they all came to an agreement that they didn't really need to worry about it, and so they just kind of went ahead and they closed the real estate transaction. Well, the lien turned out to be an effective lien, or a lien that could be enforced, and the gentleman basically lost his property because the amount of the lien was probably more than what the property was worth. And so because he was aware of it, because of his attorney was aware of it, he really had no recourse. He was just out that money. So in 1876, a group of, I believe it was attorneys, gathered in Philadelphia to form the first title insurance company. And the idea of forming that first title insurance company was to provide coverage for an owner who would be in the same position that this unfortunate gentleman found himself in. And that would protect him against liens that he was not aware of. So that's a little bit of the background. Of course, title insurance companies, there's many of them across the United States. If someone's purchased title insurance before and they've gotten a policy, it's likely that the name of the title insurance company is on their policy. So we're going to start there. We're going to start
okay.
with what title insurance is.
Okay.
And so we're going to kind of, I'll get into the types in a little bit, but we're going to start with if a person who bought a piece of property was interested in getting title insurance. Their number one question is, of course, what is it, and do I need it? And we're kind of in a society where we all try to cut corners with economics. We don't.
Right.
I mean, if you're like me and you go to a store and they ask you if you want the extended warranty, most of the times, I'll be honest with you, I just say, no, I don't want it, because if the product won't last more than 2 years, I don't want it in the first place. So most of the times I turn down because I don't want to spend another $40, $50, $60.
That might be like a television or something.
Television or any kind of electronic appliance. So, and I think most people are kind of like, how can I more efficiently and economically kind of streamline my costs? And so the question is, do I need title insurance? So the first kind of the process that we'll take you through is, what does title insurance do? And that is, it protects the value of your property. So what is the value of your property? Well, whether you own a house in the city, a village, or whether you own 50, 75, 100 acres out in the country, your land and the improvements that you have on that land are what make that property valuable. So if you live in a village and your house, and you invest the money in building or adding on to your house, that is valuable to you. You've invested time and money in that improvement. If you have a house out in the country and you've got fishing rights, hunting rights, timber rights, oil and gas rights, that property is valuable to you because it has utility purposes for you. And so when you get that, you buy the property for $50, $75, $100, $200,000, and that measures the investment that you have in that property. So the title insurance is meant to cover you for the value of your property so that you don't lose out should something come up. So the second question that would come up would be then, how does that title insurance protect you? Well, the title insurance protects you against what they call known risks, and it protects you against hidden risks.
Oh, hidden risks.
Yes, we'll get into that in just a second.
Oh.
So with the known risks, it is, again, going back to our discussion of a few months ago, the title search. When the abstractor does the search and they've searched the county records and they come across something, whether it's a lien, judgment, mortgage, tax warrant, or an encumbrance, a right-of-way, a lease, an easement, or something to that effect, the question becomes, what kind of insurance do you need for that? So again, we talked about last time, some of them are kind of standard procedure, other of them are more special and they require action to what we call cure them. So the title insurance works off the title search to determine what risks there are, what needs to be taken care of, and what you can be given insurance for. Those are the known risks. The hidden risks are those things that a title search will not produce. They are matters that are not of record, and so they protect you against what they call fraud and forgery. So for instance, if you buy a piece of property and someone who is claiming to be the owner of a property sells you the land, and obviously they use fraud to get you to lay down money, and you think you're getting a good deal.
Okay.
Yes.
You mean this is like a criminal that
Oh yeah.
sells you a piece of property that he says he owns,
Yeah,
but he doesn't?
and it may not necessarily be, a criminal like comes off the streets. It's typically an interested party, and I'm not trying to defame family members, but if you got one family person who wants to kind of benefit from the sale, he might claim that he owns 100% interest in the property. So it may not necessarily always be overtly criminal, like someone just comes in and squats in a piece of property and then tries selling it to you. It may be someone who represents
Okay,
Yeah.
it might be a member of a family that co-owns it with other
It could
family
be.
members.
It could
and-
be extended family.
Uh-huh.
It could be a neighbor, the neighbor who's been squatting on this land. It could be anyone
Using the land for some reason.
exactly who
Yeah.
is representing that they have the right to sell you that property. And of course, hopefully with a title search, it shows up, but there may be cases where it doesn't show up. The other one would be forgery. And that would be is if you've got somebody in the family and you're given a deed and that person did not actually sign the deed, but someone signed for them,
Oh,
that would cover for that. So that's what's known as the hidden risks.
oh.
And so those are things that are concerning. Again, in our area of the state, we don't really see much in the way of that. In a more urban setting where properties, and just to let you know, downstate, our most expensive properties here in Chautauqua County, downstate, that would be like pocket change, because their properties out there are usually 6 figures and sometimes even 7 figures when it comes to value, and it's very rare when we when we get something of that nature. So there's more initiative to try to do through fraud or forgery property downstate because there's a lot more money involved. So we don't really see those cases like we do downstate, but you know, anything can happen anywhere. So that's just something to
Well,
kind of keep in mind.
I do know lakefront property, it costs a lot more than away from the lake, like out in the country, in the neighborhood you and I live. You know, it's way less expensive than the Chautauqua institution or just about anywhere that's where there's lakefront property.
Right, correct.
So I know, I remember somebody who said she told me that she used to be a real estate agent over at the Chautauqua Institution, and she said, like, I think she said it was like in the 1970s and like that, you could buy a house over at Chautauqua for like $60,000, and now the houses are going for millions.
You know what the
So-
saying is? Location, location,
Location,
location.
location.
And you're absolutely right. Property values, probably in the last 50 years, have grown exponentially. You're right. Lakefront properties, and especially properties that were desired, like in the institution, were fairly affordable. But as times have changed and as they become more sought after, with the reputation of having a vacation property or a place that you can go to, those properties indeed have gone up to the point now where you might get a very small piece of property with little or no yard, and you
Right,
might
right.
pay $200,000 to $350,000
Right.
for
right.
that little piece of property. So again, it's not necessarily what it is. It might be an older cottage, but it's where it's located, and if it's on the grounds or on the lake, that will give it some value. So there is value there, especially in that particular case. So again, it is the purpose of the title insurance is to protect your investment. Now, what coverage does it provide? So, for instance, if you were to have a claim, well, there's 3 ways that it can cover you. Number one, so let's just take for an instance where you are being sued by a neighbor because part of your property encroaches on their property, or someone comes up on your doorstep and says you owe them, thousands of dollars because of an previous lien or because of a previous interest. What does that cover you? So say, for instance, that matter now goes to court. You couldn't do a handshake, you couldn't come to an agreement, and now goes to court. So the title insurance covers you for, obviously, court and attorney fees that you would need if you need to hire an attorney to defend your claim. It also covers for the eventuality if you should be able to settle with the other party. It covers for the dollar amount of the settlement. And of course, then in the third scenario, it covers for what we call a complete loss. So for instance, it goes all the way to a verdict and the court rules against you and you lose up on some or all of your investment. It covers for that eventuality as well. So it basically is there to cover for you, to give you some support and some assistance, and to let you know that if worse comes to worse, you're not going to be out your complete investment. And again, you have to. It's a risk weighing on it because people ask me, should I get title insurance? And we don't usually advise people whether they should or shouldn't. We advise them to kind of take their risk assessment, and if they need to ask their attorney for a risk assessment to determine, is this a property that's high risk, or from your opinion, is this a property that is pretty safe and sound? And again, even in those cases, someone who wants the added assurance, they could certainly purchase title insurance. Now, title insurance, getting into that part of it, the premium. The premiums are usually set by what they call the title insurance, the company in New York State. And they're based on the value of the property, so they grow as the value of the property increases, the premium increases. And it's based on a percentage, and it's across the board, so it's not as much of a competitive market where I can go this place and they'll give me this quote, and I'll go to this place and they'll give me a different quote. It's typically the same across the board because they're set by the rate manual of New York State. But the interesting thing that differs from the other kinds of insurance is that it's a one-time premium. So if you have a homeowner's insurance or you have car insurance, you pay a monthly or sometimes an annual premium.
Right.
With the title insurance, you pay a one-time premium at closing, and as long as you own that property, that premium continues throughout your ownership.
Oh, okay.
Now, there's different scenarios where the title insurance may continue, and I won't go into too much in depth because obviously different people's circumstances. But for instance, if you should want to gift your property to your children, or you want to kind of restructure your family holdings so that the property is titled differently, but it's basically in your family, and it's for what they call no consideration. In other words, no money changes hands.
Oh, okay.
That title insurance can continue. And of course, obviously, when you sell the property outside the family for an amount of money for consideration, then that title insurance expires and ceases and is no longer effective. But in that case, then the next person
Has
buys
to buy the title
their own
insurance.
title insurance.
Okay.
And so that kind of defines to you what the title insurance, what we call an owner's, or some people may hear fee policy covers. And so I'm going to kind of break off on a little bit of a different vein here to kind of explain to you the other kind of title insurance, which is what's called a mortgagee or a loan policy.
Oh.
Now, if you have bought property and you needed to get financing, most times if you've seen your settlement statement or if you sat down at the closing table and looked at the settlement statement, you'll see that the bank, more often than not, has required title insurance to cover their investment.
Oh, okay.
Now, I'm going to kind of lay out to you what the loan policy does, and then I'll tell you how it differs from the fee policy and some popular misconceptions about the two of them. So with a loan policy, the bank wants to also protect their investment. Their investment is typically the loan that they give to you. Now, it differs a little bit from an owner's policy because what is the main value for a bank when they lend you money? It's not necessarily the entire property, it is the improvement on your property. Because what is the value of the land unimproved versus what is the value of the land improved? And obviously, you know, if you've ever built a house and you know people that built houses, that value changes quite a bit, dramatically.
Right.
Once you put a house on that property. So yeah, the bank is interested in your land, but they're more interested in protecting what the main value of that is, being the house, or if it's commercial, the business, or if it's a condominium or any kind of a place where people do business. That's what they're interested in protecting. And so what they want to make sure is that there are no liens or encumbrances which could compromise the value of the home. So, for instance, and we've talked about before, rights of ways and easements and leases. Yes, there might be a utility easement on the property. Yes, there might be a easement for what they call ingress or egress, which is exiting or entering on the property by some other party. And they may not necessarily be concerned about that. They just want to make sure that those easements and rights of ways do not interfere with the house.
Oh, okay.
So you don't want the house to be sitting or encroaching on something that someone could say, you know what, this house has to go. That's, by the way, that's
yeah.
extreme. That's the worst case scenario.
Oh, yeah.
And then the bank would lose out if for some reason that house has to be restructured, torn down, or taken down in some parts, and they lose out. And so really, in a way, their insurance covers that they will not lose out on their investment, on their loan that they've given to you because something catastrophic has happened to the house. Now, this is not homeowners insurance. So if your house burns to the ground, title insurance does not cover either you or the bank because that's under your homeowner's insurance.
Oh, okay.
That's a
okay.
completely, we have nothing to do
Okay,
with that.
okay.
And again, we have people, when they ask about title insurance, say, well, I have a homeowner's policy. And that protects the actual structure. Should, like, you get water or fire or something like that.
Right.
And it protects you. The only thing that the title insurance does is protects you against is that there is no, again, liens or encumbrances which could compromise the value of that. And so banks are more and more getting into that because we live in a very volatile market. We live in a very litigation-happy market sometimes, and they just want to make sure that there's not going to be anything that will cause them to lose that value.
Yeah.
So that's really what the purpose of the loan policy is. Does that seem to kind of make sense with what?
Yeah. I have a question
Yes.
here. What if somebody buys a house or something and they die before the mortgage is paid? Now, they might have a will, where they figure if they die, the property should go to certain family members or whatever. But if this person should die, now, in order to keep the property, would the family have to finish paying the mortgage? Or probably the title insurance doesn't cover that.
No, it doesn't cover for that. What we're looking at, and again, I think some types of loans, and I'm not familiar with all kinds of loans, you can buy insurance from the bank that should something happen to you, part or all of the payments are covered. I know they do that with car loans. Yeah, with car loans, you can purchase a particular amount, and I think it's based on the value of what you're borrowing on, because I think the lenders are willing to give you a dollar amount up to a certain amount. So I think with certain kind of loans, that kind of insurance is available. But as long as we're on this topic, there are several things that could happen with that particular scenario that you're talking about. Number one, if the family does desire to keep the property, if they appoint an executor or an administrator, the executor or the administrator would be responsible for keeping up with the payments to keep it in the family, because essentially that mortgage is good in perpetuity to the heirs, successors, and assigns, as they call it, until that mortgage is paid off. So in that scenario, if it's a good piece of property, vacation property, they would still want to use it, they would continue to keep up with the mortgage. Now, if the heirs really did not desire to live or continue to keep up with the house, they could list the house and sell the house, and the proceeds would go toward paying off
the mortgage.
Going off the mortgage, correct. And there would be some sort of, they would have to call to the bank to get a payoff amount, things like that. So they could essentially sell the house and keep the money minus what they had to use.
What was still owed on the mortgage.
Exactly.
Okay.
Yep. Exactly. Now and I don't want to go off on too much of a rabbit trail, but there's obviously, you've heard of the reverse mortgages. They're advertised.
I
on TV.
have, and I'm suspicious. There's that one actor that's
Tom Selleck.
Tom Selleck, who's been advertising for reverse mortgages, and he's claiming this isn't a way to take your property away from you or anything.
Right.
But I am suspicious of this. So go ahead and say what you were going to.
So with a reverse mortgage, it benefits basically the person who's living in the house at the time. So for instance, if you're up in years and you need money now, you can apply for a reverse mortgage, and they essentially will give you a valued amount. Now, I think it's based on a percentage of what the house might be worth. Again, I'm not familiar with the nuts and the bolts, but they will lend you, give you, grant you the money that the house is worth. And it's true, as long as you own that place, you never really have to pay the money back. It appears to be free money. However, why it says it benefits the person who's living in the house, once you pass away, either your estate has to pay back the loan, or the bank then can move to take the house in foreclosure. So for instance, if the heirs said,
we can't afford it,
we don't want to pay back this mortgage, then the mortgage company can move to foreclose on the house. Now again, this person has since passed away, so they don't really care about it.
No.
At that point. So it would only be a non-benefit to your family. They could no longer do with the house what they would want to do. But if a person doesn't have family, or heaven forbid they don't get along with their family, this might be one of those things where they say, you know what, this house is not going to go anywhere beyond me. And so it's appealing to them. It's money that they don't have to pay back. But at some point, once that person has passed away, the bank does recover the value of that mortgage. Again, be it payment through the estate or an outright taking of the house
and reselling it.
Exactly.
Yeah.
So again, I would always tell people, investigate, research, ask yourself the question, is this the right thing for me? Is it the right thing for my family? Because you and I both know advertisements sound great. A 30-second commercial spot can promise you many things, but as I always tell people, buyer beware. This may work for you, but just be aware of what's going to happen after the fact. Be aware of what it means for you as far as your rights go, as far as to passing the rights along to your family. So again, always do some background checking to see if this is really the right fit for you. And we'll tell. And it just doesn't go with just mortgages. It goes with anything, whether it's buying a house, buying title insurance, getting a normal mortgage. Ask yourself what your options are, what your best fit is going to be. So again, the title insurance does not protect you should you pass away and your mortgage is still outstanding. That falls upon either maybe some sort of personal insurance that you bought, maybe even life insurance, or it may fall upon your heirs or people that you left the property. We call them devasees. It's whom you devise the property to, and so it may fall upon them. So it doesn't necessarily protect you should you pass away in the middle of your mortgage. So that's from that kind of point. Does that seem to make sense?
Okay. Yeah. I figured it would probably be a problem if the person,
yeah.
if the person passed away.
Right. And so, again, the banks want to protect their investment. And so, they may ask for specific types of coverage. And again, it typically falls upon the buyer to pay for the premium. So even though the bank is benefiting from it, oftentimes the buyer is the one who pays for the premium. I guess it's sort of the bank's way of saying, hey, we're lending you the money. Least you can do is buy the title insurance for us.
Yeah.
So that's what that is. Now, I will get into one misconception.
Okay.
And again, this is not to try to convince people one way or the other. But a lot of times, if you're at the closing table and the bank is giving you their closing statement and they say, yes, we want title insurance, and then oftentimes the buyer is given what they call a notice of availability. They're required, when you buy a property, if it's a residential property and there's an improvement on it, is required that when you are at the closing table signing documents, that you're presented a chance to buy the first type of policy, the owner's or the fee policy, at that time. So you'll get a piece of paper which will say you're being offered the chance to purchase title insurance on top of what the bank is getting. Now, again, if you're like me, it's like, do I really want to pay extra
Right,
when I'm already buying the house? And so
right.
more times often than not, people will say, it's like the warranties, I'll take my chances, things like that, unless your attorney has kind of looked at you and said, there are some things we need to address. It might not be a bad idea. So oftentimes when you're presented with a piece of paper, the first thought that comes to your mind is, well, the bank's getting title insurance, so do I really need to get title insurance? If there's a problem with a property, they got the insurance, that should kind of put to bed anything that might come up. Well, yes, the bank does get the title insurance, but their insurance, number one, doesn't cover you. And number two, it doesn't really cover the same types of risks. So, for instance, I'll give you a couple different examples. First of all, in the matter of it not covering you. So if, again, they discover that your house is sitting on, an old right-of-way or something and there's a problem, or it actually encroaches over your boundary line and your neighbor is not willing to budge, and again, these are all going to be in very generic terms because it's hard to define exactly what you'll find, what kind of neighbors you have, what kind of encumbrances you'll find. And so this is a very generic scenario. But if you discover that there's an issue and that part of the house has to be removed or has to be moved, and it's going to decrease the value of the house, well, in that decreasing of the value, the bank is covered because they have up to the value of the house of insurance that's available to them. However, that does not extend to you. And so if for some reason you lose out on what you've paid, essentially you're out that money because while it covers them, it doesn't necessarily cover you. So in that case, the insurance does not really work in your favor. The second thing is the types of insurance. We talked about essentially the bank is getting insurance on the improvement. Let's say you have larger acreage. Let's say you have 5, 10, 15, 20 acres. Well, the house is going to take up a very small percentage of that acreage.
Right.
Because even if you have a large house, it's not going to be
Probably more than an acre.
Exactly right.
Yeah.
So, for instance, let's just say you get into a spat with a neighbor, and the neighbor is claiming that about, 10, 15 acres of your 25-acre property is actually on their land, and they're making a claim to it.
Oh.
So now you get into a fight. Well, the bank really doesn't care because their investment's still covered. The house sits nicely, it's positioned. They're not going to get into this fight because, if you lost 10 or 15 acres and it's quite a ways away, it doesn't affect their investment. However, you might be concerned that the neighbor is trying to take 10 or 15 acres away from you.
Yeah.
And so if you might have to go to court. You might have to fight about it, but without the title insurance, you're not really covered for those court costs or if there is a loss of some or all of the property. Because again, the bank's policy only covers what they've got and does not cover the land. And so really in a way, even if the land is depreciated by the loss of the 10 or the 15 acres, it's not going to depreciate to the point where the house is compromised. You can still get to the road. You can still access the property. Yes, it's inconvenient that you lost your backyard. So that's the case where you're not covered because of something like that. And again, it's a very overall generic example because it might come in different shapes and form. And again, you might take a look at it from a risk assessment and say, well, we've gotten a survey. Surveys are very useful
Right.
to determine where your boundary line is, and we don't really see any encroachments. And so some people might take that risk and say, we don't really see there being an issue. There's defined boundary lines, everything matches up, and so we decide we don't need the title insurance. And so again, just the kind of the misconceptions, because I've had people come up to me and say, yeah, you know what, we're getting financing, the bank's got the title insurance, so we figured that if something goes wrong, we've got some sort of overlapping coverage, and that's simply not the case. So maybe to say that if nothing appears in the bank's policy, maybe some people feel that they won't have to worry about that, but again, the coverages are very different in their purpose and their realm of coverage. Now, with a loan policy, that loan policy is as effective as long as that mortgage remains open. Once the mortgage gets discharged, you paid your mortgage off, the mortgage gets discharged, then that loan policy expires or ceases because there's no longer an amount owed, there's no longer liability under that mortgage because you've paid it. Now, a couple different cases where that might change is that your mortgage might be what they call on the market mortgage. So, and I'm sure people are very familiar with the fact that their mortgage may be assigned to a different lender. They call that the secondary mortgage market. It might get assigned to somebody that was not the original bank. That has its own, I guess, problems with it. Some people don't like the idea that the bank that they started out with is not the bank that they ended up with. Different banks will farm out their mortgages. Some banks will keep them in-house.
And some banks get sold to other banks.
And some banks get sold to other banks. So the title insurance will continue to that, what they call an assignee, because the title insurance is for the bank, there's successors and or assigns. So even though the bank is no longer quote unquote receiving payment or in control of your mortgage, the bank that does end up with it continues to have coverage under that loan. In some cases, some people might decide that they might modify or amend their mortgage. And I don't know if we talked about this last time. I won't get into it much because it's it's another topic, but you may decide that, okay, yes, the $50,000 I borrowed was good, but it turns out I'm going to need more. And so some banks, if it's the circumstances are right, will do what they call a consolidation agreement. And that's basically where they give you additional money, be it $25,000 or $35,000 more. And then they will consolidate that new loan of $25,000 or $35,000 into your existing mortgage to bring up the value of that mortgage. And in that case, what the bank will do is they will get another loan policy to, again, keep up with the fact is now first they lent you $50,000, now you're up to $85,000, and they will get a new loan policy to keep up with what they lent you. Now, the advantage of a consolidation agreement is that you have $85,000 that you're paying on, but you're only paying mortgage tax on the new money. So rather than getting your mortgage of $50,000 paid off, discharged, and getting a new mortgage for $85,000, you're piggybacking on that $50,000 and only paying mortgage tax on the $35,000 mortgage. The same goes with the title insurance. You're not paying the full premium on the $85,000. You're getting basically a discount for the existing $50,000 that is there plus whatever you have to pay on top of the 35. So sometimes those consolidation agreements are attractive because you save money on both the mortgage tax and the title insurance. It's basically based on whether the bank is willing to do it that way.
Oh,
I mean,
okay.
you may want to do it that way, but it's based on the bank, their appraisal, how much equity you have into the property, whether they want to go that route. So those are the two instances where the title insurance would continue beyond the simple, okay, this bank is no longer entitled, or now there's more money. And so that's ways that the title insurance can be extended or continued to continue. But again, once that loan is paid off, whether it be a different lender or the money is increased, and you get that final discharge, that's when that title insurance would lapse or cease.
Okay. Okay, so you could find out, somebody could claim they have a lien on the property after that expires. This has been known to happen then?
Well, no, the lien typically, again, is good for as long as you own the property.
Oh,
So say,
okay.
for instance, we're kind of separating this from the mortgage.
Oh, okay.
And I'm assuming you're talking about if someone had a prior lien on the property. Now, if that lien were to come up after the bank's mortgage has been paid off, again, the bank probably doesn't really care at this point because they got their money.
Yeah.
And they go on to the next thing. The word they would care about is if that lien should arise in the time of their ownership of the mortgage. Now again, oftentimes it's a step process. So the lien would fall first upon the homeowner.
Okay.
So say, for instance, I'm just going to again use a generic terminology here. Let's say, for instance, they discovered a judgment, a fairly hefty judgment, prior to the time that the person bought the property of, say, $5,000. So when that lien holder comes a knocking or rings your phone or sends you a letter, it falls first upon the homeowner to dispose of that mortgage, or excuse me, of that judgment.
Okay, okay.
Which would be an unsettling and unpleasant prospect. But because the seller is long gone, and now the lien holder wants their pound of flesh, they come to you. Now, again, we're going to fall back on if you have an owner's policy of title insurance and that lien was not disclosed, and someone comes knocking on your door and you have that fee or that owner's policy, that's what that protects you from, is someone coming to you after the fact with their hand out saying, hey, there was a lien on this property and it was not paid, therefore you're responsible for paying for it. So that would be the first line of defense. Now, if in the unfortunate circumstances that the homeowner doesn't have title insurance, they either have to pay for it out of pocket, or in extreme cases, that matter could be litigated to enforce the judgment out of the value of that property. So if the person, say for instance, decide that they no longer wanted to fight this lien, they could decide to step away from it. They say, I can't pay for it. I'm just going to, again, extreme circumstances, I'm going to abandon the property. Now, the bank has to foreclose because you haven't paid this judgment. You're also not paying your mortgage, because why would you pay your mortgage on a piece of property that you've given up on? So now the bank, when they go to foreclose on this mortgage, finds out that there is a previous lien holder that they can't extinguish through the foreclosure. So now that's when their title insurance would kick in.
Oh, I get it. Okay.
Yep. Because
okay.
now their value, their investment has been compromised because there's a substantial judgment on that property that supersedes the mortgage.
Oh.
And so their mortgage is depreciated minus whatever is owed. So that's when their insurance would kick in, is when the homeowner has bailed or their title insurance has failed and now has gone to the second level, the next level of foreclosing on that mortgage. And once the bank has foreclosed on their loan. Their loan policy still continues through their ownership, through foreclosure, until the time that they sell the property to someone on the market, bona fide purchaser, one of those, I think they call them a resale, things like that. And so that would continue to protect them during that time. And so, yes, you're right. It kind of goes through stages. As long as the seller pays the mortgage, the bank is insulated typically from that. But once they decide that they can no longer take care of it and it goes into that mortgage foreclosure, that's when the bank's coverage kind of kicks in and protects the bank's investment in the value of that property. So there's many other things that you can kind of consider. I don't know if you had any specific questions about. I know I kind of went through those on a very thumbnail sketch.
Yeah. Yeah, I don't really know much of anything about title searches or anything like that, but I can see that it is very important to have that done so that you make sure that you're not buying property that part of it belongs to somebody else besides the seller you're planning on buying from.
Right.
And definitely to have a survey done and to have all of this stuff done, to make sure that you're not buying property that's going to turn into a big problem.
Right.
So
Right.
I know the Mayville Diner that burned down a year ago, that mess has been finally cleared away. One day when we were driving through town, well, we were coming home from town and we came around the corner by the red light and there was a car pulled over on the side of the road, except that there's really no room for cars to pull over, but there was one pulled over there by where the diner was, and there was at least 4 guys that must have gotten out of that car, and they're standing there talking on all of them on their cell phones. I don't know what was going on, if they were somebody thinking about purchasing the property or something, I don't know.
Yeah.
But that was kind of interesting, but they shouldn't have been pulled over where
yeah.
they were. They should have pulled into the parking lot at least
Right.
because they were obstructing traffic.
Yep. And you know what? It'd be kind of interesting because obviously, again, if there had been title insurance on that structure, it wouldn't have covered for the place burning to the ground. It basically, should someone maybe in the future want to develop it, whether it be rebuilding or just simply using it for parking, at that point, once a search is done to see what possible liens are out there, if there's any financing that's still open.
I'm pretty sure I've heard there's a lien.
Oh, I know. There's
that-
there's liens now with all the work that's been gone in to kind of clean that up. At some point, they'll have to countenance that. So really, in a way, at that point, if someone is interested in purchasing it for commercial or for vacant purposes, it'd be a matter of what can be done to kind of protect the future. Now, I will tell you this about title insurance. There are some times that title insurance cannot or will not cover you when a lien is known about and there's no way of curing it. So, for instance, if doing a title search, there is a fairly substantial mortgage on the property that is not that old that the previous owner had, and the person who's buying the property says, well, we can't find out who owns this mortgage. We can't find out how much is owing on it. So we want title insurance to protect us from that. Well, in some cases, in an older mortgage, and the circumstances have to be right, you could protect that no one's going to try to collect because the mortgage is so old that no one's going to bother to try to enforce a 20 or 30 or 40-year-old mortgage that no one's paid on for 20 or 30 or 40 years. But in some cases, if the mortgage appears to be active, there appears to be payments made, the title insurance may say, the only way that you're going to cure this, since title insurance is not going to protect you from this, is by trying to figure out who owns this mortgage, how much is owed on it, and if they'd be willing to settle for a lower amount because the risk is too high. It's one of those things where title insurance companies, like any other company, will assess the insurability based on the risk. So I'm just going to give you a very quaint example. If you have a car and you've had multiple claims because you have accidents,
Oh,
a prospective title or prospective car insurance might either not give you car insurance because you're a risk, or if they do give you, your premium is going to be much higher because you are higher risk. And again, with title insurance, they might look at that and say, this is still an active mortgage. We don't want to insure this property because this mortgage still appears to be fluid, and the amount of money is so great that the risk of insuring this is too great without getting some sort of reassurances from outside parties, be it from the bank, through payoffs, or someone actually reaching out and trying to pay that mortgage off.
now, you work for a business called Chautauqua Abstract, and
Correct.
apparently you deal with all of these title searches
Correct.
and everything. So now, just exactly, how do you help people?
Well, we most of the times, most of our clients, if I could say it that way, are attorneys that are trying to close a deal.
Oh, okay.
They could be a seller's attorney representing a seller
Uh-huh.
who's trying to clean up any liens or encumbrances, or it could be a buyer's attorney who is trying to help his client get a mortgage where the bank requires title insurance, or has questions about titles that his client might have about what they're getting themselves into. And of course, we're kind of unique in our particular case because our title searches and our title insurance are basically both in-house. So we do the searches and then we write the title insurance off of the title searches. In some parts of the country where the abstracting arm and the title insurance arm are separate entities,
Oh, okay.
you have to rely on someone else's product to write the title insurance.
Okay.
In our case, we basically, again, keep things in-house, so we do the abstract and then we can do the title insurance.
Oh, okay.
And then, again, we write the title insurance off of what we see as objections, in other words, things that had to be taken care of before you can close, old or a mortgage, unpaid taxes. It could be a number of things. Or what we call exceptions to title. Those are things which really can't be disposed of. And I think I mentioned last time, if you've got a telephone easement or an electric easement, those are things that you really can't do anything about because they're necessary.
Right, right.
I mean, if you want a telephone company to dig up your line or the electric company to get rid of their easement in their line, you won't have phone or electricity.
Right, exactly, exactly.
So those are things which we will accept because they are matters of record. They offer typically very little risk to the property, but again, because they take priority, because they were signed years ago, they take priority over any other claims in the future. So if you bought a house and you said, wait a minute, no one told me there was a utility easement here. No one told me there was a sewer line here. Well, the title insurance company says, well, yes, but in your title policy, we said easement to National Grid, easement to the old Chautauqua and Erie Telephone Company, or to the sewer district. And there are exceptions to your title because, you can't, they take superior claim. You can't go out there and dig up their lines.
You can't get rid of
them. And so the title is subject to
the easement.
those easements. And again, that's an extreme example because who really thinks about telling the utility companies to
Okay, so your office and surveyors sort of cooperate with each other?
Well, the surveying is the kind of the first step. When you get ready to buy a house or the bank is getting ready to give you a loan, they will ask for a survey. That's kind of the first step because you want to find out, first of all, are all your improvements within the boundary lines? Does anyone else's improvements encroach onto your property? So you kind of want to get a feel for the land. Where's everything situated? Now, for residential, whether it's in the city or the village, that's a lot more sensitive because the boundary lines are a lot smaller.
Right.
You might own a 50 by 120 lot, whereas in the country you might have
Acres.
where there's very little risk that you have much in the way of encroachments. So the surveys are the first things that are done. Now, interestingly enough, it's kind of like the surveyors will ask for the title search, which I brought in last time, so they can kind of see the historic descriptions that were used, the historic nature of the property, so they can kind of get a feel for the property. So it might be abstract of title, surveys, and then the title insurance itself is written off of the title search, which was done in the first place, the surveys, which were done in the second place, and then the title insurance product, which is done. If we still have time.
We have a minute.
Okay, really quickly then, I'll shoehorn this in. There's two stages typically. The title insurance commitment, which is done before you buy your property. It gives you a chance to evaluate what's out there, what risks there are, what things need to be cured. And then the title policy is usually done after you've bought the property, you signed, sealed, delivered the deed, and the policy is written off of the commitment, but it gives you an idea in hand. Okay, I saw in the commitment what's here. This is my final title insurance product. I can rely on this. It's got all the contact information in there. If I have questions or contacts, I can reach out to them. That's what we're looking for.
Oh, yeah. There's a lot a person has to do to protect themselves these days.
Yep.
Well, I wanted to say thank you again.
Well, thanks for having me.
For coming on again. I'm sure that the information you bring to Fresh Perspectives is very helpful to people who are buying or selling property. And maybe we can have you come on again sometime and talk about some more things that have to do with what you do.
That'd be fine.
And I will see the rest of you in the viewing audience on the next episode.